Hey guys, welcome back to the channel where I share with you investing, trading, and the stock market videos each week. In today's video, I'll be sharing the 5 things that I learned from William O'Neill. William O'Neill is one of the market wizards featured in Jack Schwager's best-selling book, Market Wizards. And he's the founder of Investors Business Daily, which is one of the leading publications in the stock market. I'll be sharing with you some of William O'Neill's strategy and the lessons that I learned from William O'Neill's books. The first lesson that I learned is William O'Neill's trading method, specifically the Canslim method. The Canslim method is a method that William O'Neill uses, which has allowed him to be successful and profitable in the stock market. William O'Neill wasn't always successful in the stock market. William O'Neill was frustrated by his lack of progress in the stock market, even though at that time he had subscribed to a couple of investment letters. Frustrated, William O'Neill began to look for ways to turn things around. He went to study on stocks which had generated superior performance in the past, and he decided to search and focus on the characteristics of these stocks. And that is how he arrived at the Canslim method. So what is the Canslim method? The Canslim method is a 7-step process in which William O'Neill uses to look for stocks which has the potential to generate superior performance. The first thing that he looks at is current quarterly earnings per share, and the second thing is the annual earnings per share, followed by something new, and the next one is shares outstanding, followed by leader or laggard, and institutional sponsorship, and the last one is market direction. Now let's take a look at the individual criteria. For the first step, William O'Neill wants to see the stock having a current quarterly earnings be up by at least 20% in the most recent financial quarter compared to the same quarter a year ago. And for the second step, for the annual earnings per share, William O'Neill wants to see the stock having an annual earnings growth of at least 20% over the past 5 years. And ideally, each year's EPS show an increase over the prior year's earnings. The next thing that he looks up for is something new. This new refers to a new product or service or a change in industry or even new management. And this new also refers to a new high price for the stock. So William O'Neill pays attention to stocks whose company has something new in this regard. Either a new product, new service, or a change in industry or new management or even a new high price. And the next thing that we'll take a look at is shares outstanding. William O'Neill noticed that outstanding performing stocks tend to have less than 25 million shares outstanding during the period when they had their best performance. So he wants to look out for companies who do not have a large amount of shares outstanding. William O'Neill also wants to pick the leading stocks, so ones with high relative strength, and avoid the laggard stocks. He only wants to invest and trade in leading companies in leading industries. And he looks at the relative strength of the stock to determine whether the company is a leader or a laggard. The relative strength of a stock measures the price performance of a stock compared to a benchmark. Typically, the benchmark is the S&P 500 for US stocks. And for other countries' stocks, the benchmark will be the country's own individual index. So William O'Neill will pay attention to stocks with high relative strength because this typically indicates that the stock is a leading stock. The next is institutional sponsorship. And institutional sponsorship means the ownership of the stock by mutual funds, banks, and other large institutions. And the reason why William O'Neill wants to see a stock having institutional sponsorship because leading stocks usually have institutional backing. And the last criteria for the Canslim method is market direction. Majority of the stocks will go in the same direction as a significant move in the market averages. And William O'Neill believes that if we want to have a high probability of success in the stock market, we want to invest and trade in the same direction as the market. And the S&P 500 is usually used to determine the overall market direction. So these are the 7 steps and the 7 criteria in the Canslim method used by William O'Neill. So C stands for current quarterly earnings per share, A is annual earnings per share, N is for new, S is for shares outstanding, L is for leader or laggard, and I is for institutional sponsorship, and M is for market direction. The second lesson that I learned from William O'Neill's book is to buy high. This might puzzle some of you because the mainstream media has been telling us to always buy low and sell high. So this lesson on buying high might seem counterintuitive because one of the greatest paradoxes of the stock market is that what seems too high usually goes higher and what seems too low usually goes lower. Many investors and traders tend to avoid buying a stock when it reaches a new high. And even more investors tend to go bottom fishing for stocks. They look for stocks which are at their 52-week low or at their absolute lowest. And they confuse price with value. After spending time researching and studying stocks which have generated superior performance in the past, William O'Neill noticed that to get superior performance, don't buy stocks that are near their lows. So William O'Neill believes in buying stocks which are making new highs and avoiding stocks which are making new lows. So the second lesson that I learned from William O'Neill is to avoid buying stocks just because their price is low, and instead look for stocks that are making new highs because these stocks tend to have a higher probability of achieving superior performance compared to stocks that are making new lows. The third lesson that I learned from William O'Neill is taking profits. Knowing what to buy and when to buy it is just one part of the equation. The second part of the equation is knowing when to sell. More specifically, when to take profits. And in this situation, when we are in the green or making money on our position, when to take profits. Knowing when to take profits is equally, if not more important than knowing what to buy and when to buy them. After all, it's only through selling and taking profits that we are able to lock in our profits. And William O'Neill has this to say about taking profits. Let your profits run as long as the stock is performing properly. Sometimes as investors and traders in the stock market, we tend to be over-eager in taking profits. We fear that if we do not take profits now, when we make some profits, we rush to take profits because we are afraid that these profits might get away and even turn into a loss. But as long as the stock is performing properly, William O'Neill believes that we should let our profits continue to run. And he also advises us to accept that we will never sell at the exact top. And William O'Neill wants us to know that it's alright that after we sell and take profits, that the stock price continues to move up after that. We'll never be able to sell at the exact top, but we do not have to do that to be successful and profitable in the stock market. And the fourth lesson that I learned from William O'Neill is this investing secret. And the reason why I use this open and inverted commas is because this secret is not really a secret. This secret is a very simple secret and many people know about it. However, knowing is just one thing. Practicing it and implementing it is a different thing. The key to being profitable and successful in the stock market is to lose the least amount of money possible when wrong. And many people would think, isn't this obvious, that we should lose the least amount of money when we are wrong? However, they do not actually implement it in their investing and trading in the stock markets. For example, when the price of a stock goes against them, and when they are losing just a small sum of money at first, these very same people will be unwilling to take a small loss on their position. Instead, they harbor hopes that the stock price will eventually go up, for them to break even at least, or even make a profit on it. And sometimes not cutting their losses fast and when they are small can cause these losses to turn into big losses. And experiencing these huge losses in the stock market is detrimental to the success and profitability of an investor and trader. And that is why this investing secret is to lose the least amount of money possible when wrong. And for William O'Neill, he made it a rule to never lose more than a maximum of 7% of any stock he buys. If a stock drops 7% below his purchase price, he will immediately sell it without any hesitation. And that is how William O'Neill keeps his losses small and loses the least amount of money when he is wrong in the stock market. The fifth lesson that I learned from William O'Neill's books are some common investing mistakes. And the first mistake is buying when prices are moving down. Again, this William O'Neill advice might seem counterintuitive. Don't we want to buy more of a stock when the price goes down? After all, if it's a stock that we are taking a look at, when the price of the stock goes down, aren't we getting a discount on that stock? William O'Neill believes otherwise. He believes that we should never average down on our positions. Because if we had bought the stock and the price of the stock goes down after we have bought it, it shows that we are wrong on our initial position. And when we are wrong about our position, we should look to exit our position and cut our losses, and not continue to buy even more of that stock when we are wrong. The second common investing mistake is to buy stocks just because they are cheap and at low prices. Many investors buy stocks just because the stocks have low PE ratios. And William O'Neill believes that a low PE is probably low because the company's past record is inferior or not good. Which means that a company has a low PE ratio for a reason. Therefore, we want to avoid buying stocks just because of their low PE ratios. Another thing is not buying a stock just because it is making new highs, which we have mentioned in the earlier part of this video. And the reason why investors and traders want to avoid buying stocks when these stocks are making new highs is because they want to buy stocks that are cheap and low prices. And that William O'Neill believes is a common investing mistake. The third common investing mistake is to hold on to losses. Unsuccessful and unprofitable traders don't take their losses when they are small. They will hope and wait until their losses become too big to bear and then they exit their positions. And this relates back to the fourth lesson, which is we want to lose the least amount of money when we are wrong in the stock market. These are the 5 lessons that I learned from William O'Neill. If you have enjoyed and learned something from this video, smash that like button because it will really help the channel grow and allow me to produce more content such as this. And if you want more investing and trading tips video, make sure you subscribe to my channel because each week I release one new video about investing, trading and the stock market. I'll see you in those other videos. To your financial success.